Physical Gold Fund presents the Gold Chronicles with Jim Rickards and Alex Stanczyk. Insights and analysis about economics, geopolitics, global finance, and gold.
Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest webinar with Jim Rickards and Alex Stanczyk in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim. You're in Berlin today, I believe.
I am, John. Thank you. It's nice here in Berlin. Nice to be with you in the audience.
And we also have with us Alex Stanczyk, the managing director of Physical Gold Fund. Alex is an expert in the physical gold industry. He's been dealing with the logistics chain from refinery to secure transport and with vaulting. And he's lectured globally to investor and institutional and government audiences on the role of gold both in the international monetary system and an investment portfolio. Hello, Alex.
Hi, John. Great to be here as well.
Then later in this podcast, Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions today are more than welcome. You can post them at any point during the interviews. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. Well, gentlemen, here we are just one day after the last meeting of the Federal Open Market Committee in 2016, and as predicted, rates are up. Jim, any surprises in yesterday's pronouncements from the Fed? And could you tell us perhaps a little bit about the implications for gold?
Sure, John. There were a lot of surprises. Of course, the rate hike itself was no surprise. It was fully anticipated. We had said this to listeners on this podcast months in advance, and others did as well. I saw one survey just before, I think it was the day before the rate hike, so on Tuesday, and it had surveyed 120 economists, and 120 out of 120 expected a rate hike. So this was the most heavily anticipated rate hike in history probably, and also right at 25 basis points. That's what happened. So absolutely no surprise there. But if you watched and I did watch Janet Yellen's press conference, read the FOMC statement, and combine that with a little nuance. It's never just a question of taking the words at face value. Believe it or not, you get a lot more out of watching the video live than even reading a transcript, just because body language can tell you something. Certainly one of the inferential techniques I used. There was a lot in that. First of all, the obvious one has been widely reported that the Fed, the FOMC members, in their forecasts and their estimates, said that they expected 3 rate increases in 2017. That's in addition to the one yesterday. So we had the one yesterday, but 3 more in 2017. That would get the Fed funds rate up to 1.25. Their prior forecast going back to last September was for 2. So that by itself was a big deal. That, again, that's been pretty widely reported. But beyond that, I found Yellen's response to some of the questions, and reading between the lines a little, but not much. I thought she was fairly explicit about Donald Trump's fiscal policies, the Fed's reaction to fiscal policy, and also her views on inflation and what she thought the economy was going to do, and even on her own status as chairman, all of which was fascinating. I thought she was very blunt. I thought she I formulated this thesis before, but yesterday really cemented my view that we are looking at a head-on collision between Donald Trump and Janet Yellen. I'm writing an article on this. I'm subtitling it. Still working on the subtitle. Maybe the clash of titans, or King Kong versus Godzilla. Take your pick on who's who. But I think Yellen and Trump are on a collision course. I think that was in the air. Trump probably started the fight with his remarks about wanting to fire her during the campaign. Of course, he can't legally fire her, but that doesn't stop Trump from making the rhetorical gesture. But I thought she sort of fired back in kind yesterday. Just to be specific on that, John, and kind of put a little color behind those remarks, it was interesting because I thought the questions were planted, not unusual for policymakers. I've certainly written questions that were tended to be asked in public by well-known officials. Sometimes you get a call and you get the invitation, do you have any questions for, and then kind of fill in the blank, whether it's a senator or policymaker, or whatever, and they don't always get asked, but sometimes you are invited to submit those questions. And when Steve Leisman of CNBC stood up, I just felt that he was spoon feeding her softballs about Trump's fiscal policy and inviting her to respond. And I thought the response was fairly tough. And this is why, I mean, markets run these trends anyway. There were no trend reversals. Stocks are up, interest rates are up, bonds are down, gold is down. You can kind of look across. People call it the Trump trade. And some of it started before the election. It all accelerated as a result of the election, and it accelerated even more today, even more dramatically. She was sort of hitting that head on. But in particular, she was asked about the impact of fiscal policy. Did fiscal policy affect the Fed's thinking? Well, pretty clearly it did. Not much has changed in the economic data between last September and now. But obviously we had an earthquake electorally in terms of the election of Donald Trump and his cabinet selections and what he wants to do with fiscal policy. And the Fed's looking at that. Now, what has Trump actually said? And we remarked earlier that Trump is such a controversial figure. A lot of people had difficulty getting past his personality and his demeanor during the campaign to actually look at his policies. But once it was clear that he's the president and was elected the president, people got past that and looked at the policies. And what he's called for is extremely stimulative. He wants $1 trillion of additional spending. He wants tax cuts on top of the $1 trillion of infrastructure spending. And he wants less regulation. Well, if you take that at face value, if you throw that kind of additional spending on an economy that's already, close to capacity, you can debate, labor force participation, but unemployment is 4.6%. This expansion is 8 years old. It's not clear how much additional slack there is in the economy. There's certainly some, but not that much. So, man, if you put $1 trillion of spending and tax cuts on an economy that's already operating at or near capacity, you're going to get inflation. And, there's the Keynesianism 101 says that if people don't spend, the government will. People, in fact, have not been spending. That they get gains in income have been scarce, but if people get them, they tend to pay down debt or save the money. They don't go out and spend it. We're in a little bit of a liquidity trap. But if you hand over the checkbook to the government and tell the government to spend the money, they'll do a very good job of spending the money. That's what governments are good at. So Yellen's looking at this and saying, okay, you throw $1 trillion of spending, tax cuts, economies, near capacity, unemployment's 4.6%. You're definitely going to get inflation. And what she said was they're going to lean into it. They're not going to let that inflation take off. She also made the comment that not all fiscal policy is equally stimulative, because that was Steve Leisman's question, saying, in so many words that she said, certain kinds of spending are add to productivity, like spending on education, retraining, and certain limited kinds of infrastructure. But other kinds of spending don't add to productivity. They might add to spending, but they don't make people more productive. And clearly, in my view, she was talking about the kinds of tax cuts that Trump is proposing. Trump wants to cut the personal income tax rate from about 40% to around 33%. Now, half the people in the United States, 50% of the people in the United States pay no income tax. You could cut income taxes to zero, and it would have no impact on that half, because they don't pay any income taxes to begin with. So in other words, those kind of tax cuts only apply to upper income individuals. I don't want to debate the policy. That we can, the listeners can decide that on their own. But what she was saying as an economist is that if the wealthiest people get the tax cut, they have a very low, what's called propensity to consume. When you give rich people a tax cut, they don't go out and buy another TV. They already have 10 TVs and 3 houses and 8 cars and everything else. So they're not really going to spend it. They might invest it, or they might just save it, but it doesn't necessarily do a lot in terms of adding to the productivity of the economy. It's a little bit of a giveaway, at least in Yellen's view. Again, I'm not saying I agree with all that, but I'm just trying to interpret the way Janet Yellen thinks about it, versus some other kinds of fiscal stimulus that might add to productivity. So she's saying, so if you inject that kind of money into the economy in the form of tax cuts, but don't do anything to add to productivity, you're just going to get inflation, or maybe even worse, maybe get stagflation. And the Fed is not going to let that happen. And this is the answer to the helicopter money question, because you have to ask yourself, what is helicopter money? Helicopter money, the image is that the Fed prints up money and they put it in helicopters and throw it out of the helicopters and it lands on the ground and people scoop it up and go out and spend it. It's a colorful metaphor, but of course that's not actually what helicopter money is. What it is a combination of fiscal and monetary policy. And the elites have been calling for this for a long time, independent of Trump's election. People like Larry Summers and other economists have been saying that, and even Janet Yellen herself has said that monetary policy has reached the end of what it can do. Monetary policy is running out of impact, running out of juice, so to speak, and they need to combine it with fiscal policy, and that would, at some level, mean larger deficits, and then the deficits would be covered by borrowings, by bond issues, and then the Fed would buy the bonds, and in fact monetize the bonds and put them away and not sell them. So you'd have money printing, but it would be going directly into government spending, not just into the banks, and the banks give it back to the Fed as excess reserves. So that's what helicopter money is. Now the question is, when do you use helicopter money? The classic formulation that was first articulated by Milton Friedman and later repeated by Ben Bernanke, and I'm sure Janet Yellen agrees, is that helicopter money is something you use when you have deflation. If you actually get into a deflationary trap, which is very, very destructive of government finance and increases the real value of debt and makes debt defaults more likely, you might use helicopter money to get out of deflation. But Yellen's sitting there saying, we don't have deflation. We have inflation. Now, inflation is low, but she sees it going a lot higher because of the constraints in the labor market. Remember, Janet Yellen is a big believer in the Phillips curve. The Phillips curve says there's a trade-off between employment and inflation, that up to a certain point, you can, in effect, print money, stimulate the economy, and not get inflation because more people are getting jobs. You're bringing people back into the workforce. But when you get to the point when there's nobody left to come back into the workforce, regardless of the reason, it could be structural, demographic, or otherwise, but when labor conditions are tight and you keep printing money, you're going to get inflation. And that's where Yellen thinks we are. Again, I don't want to debate that. I don't personally agree that that's where we are, but my view doesn't matter. What matters for understanding policy is what she thinks. So she's saying we don't need helicopter money. We've got rising oil prices, inflation's accelerating, unemployment is low, there's not much slack in the labor market. So this is not a circumstance when you would use helicopter money. And for those who expected it, she really slammed the door yesterday. She talked about Trump's stimulus, as I mentioned. She said this is not the kind of stimulus that adds to productivity. It is the kind of stimulus, perhaps, that will cause inflation. We, the Fed, are not going to allow that to happen. We want inflation to be a little higher, but not a lot higher. We don't think deflation is a problem. We don't think these are the circumstances when you can use helicopter money. And we're going to lean into it. That was a very big deal because she's, in effect, challenging Trump, saying, if you use fiscal policy to stimulate the economy, we will use monetary policy to make sure that that stimulus doesn't go too far, at least as far as nominal price increases are concerned. So that was one challenge or one confrontation with Trump. The other one was even more interesting, a little bit of inside baseball, but a lot of people may know that Janet Yellen's term as chairman of the board of the Federal Reserve Board expires next January. It might be February 1st, but basically, let's call it February 1st, 2018. Not that far away, 14 months, or actually less, a little over 13 months. Trump ran around on the campaign trail and said he was going to fire Yellen, which he can't, but it's pretty clear that he won't reappoint her. So when her term is up, someone else is going to be chairman. And a lot of people think that's the end of Janet Yellen. But she's also a governor in addition to being the chair, and governors have 14-year terms. Her 14-year term as governor goes to 2028. And she hinted, at least, at the fact that even if Trump does not reappoint her as chairman, she may stay on the board as a governor and just be a thorn in his side and basically deprive him of the ability to fill that seat. Now, traditionally, when a chairman's term is up, if they don't get reappointed, they leave the board even though their governor term goes on a lot longer. You know, Ben Bernanke was an example when President Obama did not reappoint Ben Bernanke and picked Janet Yellen at the end of 2013. Bernanke resigned. He left the board. He didn't hang around as a governor, although he could have. This actually hasn't happened since 1949. It was Mariner Eccles, who was the chairman at the time, was not reappointed by President Truman. as chairman, but he stayed on the board for 3 years until 1951. So by saying that, Yellen was saying, I might just sit in my seat and be a pain in your neck and not give you the opportunity to reshape the board as much as you think. So I thought she confronted him in two ways. Number one, I heard her say she's not going to do helicopter money, and that if we get the kind of stimulus that Trump is talking about on the fiscal side, the Fed will tighten even more. And number two, she might hang around even if she's not reappointed as chair, just to be a vote for more rate increases and deprive Donald Trump of the ability to fill that seat. Both of those things are hawkish. And the board, the FOMC, was already hawkish by increasing the projected rate increases from 2 to 3. So this was a super hawkish message coming out of the Fed, and that's how markets interpreted it. Now, again, bonds down, gold down, that's all pretty easy to understand. Positive real rates, that's when the nominal interest rate is significantly higher than the rate of inflation. So, a simple example would be you get up to 3% on a 10-year note, and inflation's about 2% or less. Your positive real rate is, in that example, 1% or more. That's a headwind for gold. There's no question about it, because gold doesn't have a yield. That's another issue. Gold, in my view, is not supposed to have a yield. Of course, it doesn't have a yield. It's money. But people allocating assets don't think of it that way. They think of, I can buy stocks, I can buy bonds, I can buy foreign currencies, I can buy gold. And if I can get positive real returns of 1.5%, and nominal returns of 3% or more versus zero on gold, why would I have gold? I'd buy bonds. So that's why gold is down so significantly, particularly today. Had a very large drawdown today. So I heard a very hawkish Fed, headwinds for gold. I'll finish there, John, because I know we have a lot else to say, but maybe later in the podcast we can come back to how this is actually going to play out, because the scenario I just described, when, why stocks are euphoric, the Trump reflation trade, the Trump trade, stocks up, bonds down, gold down, interest rates up, all of that, in my view, is subject for a major, major reversal, not right away, but maybe by the end of February, early March. I think things are going to play out very differently than I just described. But for now, they are the way I described. This is what markets expect. And the Fed did nothing to steer anyone away from that view yesterday. In fact, they were pretty clear that they think rates are on a very steeply upward path.
Well, thanks, Jim. Yeah, let's build on that, actually, because one of the really stunning consequences of the election has been a pretty dramatic buoyancy in the financial markets. The Dow has shot up some 1,200 points on Mr. Trump's victory. And I wanted to ask you, and I think you're beginning to answer this already, is this a case of irrational exuberance? Or does the new administration give reason for economic optimism and therefore, of course, pessimism for the future dollar price of gold? What are your thoughts on this?
Well, I do think it's a case of irrational exuberance, and I'll explain why. But remember, John, I'm sure you do, that the phrase irrational exuberance in reference to the stock market, stock prices going up, and looking at them saying, there's really no good reason for this. There's no fundamental reason for this. It's just a case of, euphoria or trend following or momentum. That's what that phrase came from. Alan Greenspan. Alan Greenspan coined the phrase irrational exuberance, but he said it in December of 1996. The stock market peaked on January 1st, 2000. It was 3 full years before reality caught up with the stock market. So even though Greenspan was worried about irrational exuberance in 1996, the market went up for 3 more years. So for me to sit here today and say, yeah, John, I think it's irrational exuberance, that's interesting. And again, I'll explain why, but don't rule out the fact that just because things are irrational doesn't mean they cannot get more irrational. And we all know that about markets. Let me put a finer point on that. So let's just take the markets one at a time. Why are stocks going up? Well, it's fairly straightforward. You look at Trump's policies. What are his policies? He's talking about lower taxes, less regulation, and lots of spending. So you're a stock market investor. You say, okay, lower taxes. Well, that means consumers are going to have more money in their pockets, so I'm going to buy consumer non-durables. You're going to spend money on defense, so let's buy Boeing, Lockheed, Raytheon. You want to spend more money on infrastructure. Well, let's buy, John Deere and Caterpillar. You want to get rid of Obamacare? Well, let's buy pharmaceuticals. You want to get rid of Dodd-Frank? Well, let's buy banks. It's buy, buy, buy. In other words, when you look at the Trump program, it's hard to find a sector in the stock market that you wouldn't want to buy because all of his policies individually are good for one or more of these sectors. So, they say good for pharmaceuticals, good for banks, good for construction, good for defense contractors, good for consumers. What's not to like? The problem with that is, will any of it actually happen? See, this is what the markets expect. This is what Trump has called for. But let's take a minute and think about the reality. Let's call it the cold hard reality of what I just described. Now, first of all, that policy of lower taxes, less regulation, more government spending, that was Ronald Reagan's policy. That was exactly what Ronald Reagan championed and what he ultimately delivered. But there are a lot of caveats or footnotes around that. First of all, when Ronald Reagan said that, interest rates were 20%. When Ronald Reagan was sworn in January 1981, interest rates were 20%. They had nowhere to go but down. I mean, they were as high as they had been since the Civil War. Paul Volcker took them there to destroy inflation. Inflation wasn't quite killed off. It took another couple of years to do it, and interest rates remained at high levels. But that was as high as they ever got. They basically had nowhere to go but down, and they did go down a lot, which obviously was great for the bond market. Inflation was 15%, 14 and change, but between 14 and 15% when Reagan was sworn in. It had nowhere to go but down, and it did go down. By 1983, it was back down into single digits, and by the 1990s, it was extremely low, and then by 2000, it was zero or negative. So inflation came down for 20 years after that. Well, where's inflation today? It's about 1.5%. It's got nowhere to go but up. And then finally, the stock market was decade-long lows. And also remember the first 2 years of the Reagan administration, 1981 and 1982, we had the worst recession since the Great Depression. In fact, all the way up until 2008, the financial panic of 2008, that 81-82 recession was the worst recession since the end of World War II. And so the economy went through a very rough time. So the Reagan boom that everyone remembers, and it was real, but that was 1983, 84, 85, and 86. Those were the boom years, and the economy grew enormously. But it grew from the position of coming out of the worst recession since the end of World War II, and interest rates that had nowhere to go but down, et cetera, et cetera. The other thing Reagan had going for him, the debt to GDP ratio of the United States when Reagan was sworn in was 35%. He had massive headroom. He could be a big spender and run large deficits, which he did. I mean, the idea that Reagan was fiscally conservative is just not true. Reagan was a big spender and took the debt to GDP ratio from 35% to 55%. When Reagan left office, it was 55%. So take the 20-point increase divided by 35, which is where he started. That's a 60% increase approximately in the debt to GDP ratio. Trump, let's compare that, everything I just said, to where Trump is today. Interest rates are close to zero. It has nowhere to go but up. Inflation's close to zero, nowhere to go but up. The economy is not in a recession. It's in the 8th year of an expansion. What that means is you get a lot less bang for the buck. People are familiar with the Keynesian multiplier. I do $1 of government spending, but I get, $1.50 or $1.40 of additional GDP because I spend $1, on a defense contract, so the defense contractor hires a worker. That worker gets a job. He then hires a babysitter. The babysitter, takes a taxi cab home. I mean, that's velocity. That dollar gets turned into more than $1 of goods and services, and the economy grows. That's the Keynesian multiplier. But when you're at capacity, when you're in the 8th year of an expansion, you get diminishing marginal returns. The multiplier is not constant. It's not like the speed of light. It can change. It does change. And in current conditions, the multiplier could actually be negative. You might get, for $1 of government spending, you might get maybe 95 cents or 90 cents of additional GDP. And in fact, that's very likely. This is all theoretical. I mean, there's a lot of evidence to back it up, but you never know where you are at a point in time. You've got to let the economy play out, go back and look at the data, and then you can compute it after the fact. But it's not like a speedometer. You can just look at it and tell how fast you're going. You have to estimate it theoretically. But again, given capacity constraints, eighth year of recovery, it's very likely that we're in negative territory, which means a dollar of government spending doesn't even get you a dollar of GDP. It gets you maybe 98 cents because people are using the money to pay off debt, or they're saving it, or they're not spending it one way or the other. So we're in that territory. So we're not going to get a pop from declining interest rates. We're not going to get a pop from declining inflation, from disinflation. We're not going to get a pop from the Keynesian multiplier. So even if Trump did what he said, it's not going to have the same effect as Reagan because our initial conditions are completely different. Beyond that, it's looking less and less likely that Trump's going to be able to do what he said. And this is not a question of reneging on promises. It's a question of political reality because Paul Ryan and Mitch McConnell, the Republican leadership in the House and the Senate, they know these numbers as well as I do. Paul Ryan probably, dreams about them in his sleep. Just think about what the Republicans did for the last 8 years. The Republicans fought Obama. They fought the White House tooth and nail on what? Budget deficits, debt ceilings, the fiscal cliff, shutting down the government. Remember all those debates? Remember Ted Cruz standing up in the Senate in 2011 and threatening to shut down the government? And they did actually have short shutdowns. Remember the fiscal cliff, the refusal to raise the debt ceiling so the Treasury could issue more debt. Remember Joe Rosenthal and his $1 trillion platinum coin, all that stuff. And that's all you heard in 2010, 2011, 2012. You haven't heard about the last 2 years because the Republicans and Democrats did a deal to take it off the table for the election cycle. But now it's back. So with the Republicans having fought Obama tooth and nail over the debt ceiling, how are the Republicans, now that the Republicans are in charge of everything, how are they going to raise the debt ceiling? I mean, they're going to look like complete hypocrites. Now, they probably will. Don't get me wrong. Hypocrisy never stopped a politician from doing anything. But my point being, they're not going to be able to be very credibly just let spending go wherever it wants, or raise the debt ceiling $1 trillion so Steve Bannon can build the Trump's senior advisor can build roads, bridges, tunnels, and airports, and all the other stuff they want to do. And Mitch McConnell has said that tax cuts have to be revenue neutral. And by the way the Senate works, Mitch McConnell is the Senate majority leader. He can single-handedly stop the Senate in its tracks. Nothing will happen in the Senate unless Mitch McConnell wants it to happen. And so if he says, and he did say, that tax cuts have to be revenue neutral, that means if you want to cut taxes on the wealthy from 40% to 33%, you've got to compute how much it's going to cost, and you've got to make it up someplace else. Now, they could do a lot of things. They could get rid of deductions. They could get rid of home mortgage interest deductions. They could get rid of charitable deductions. They got rid of the 3-martini lunch a long time ago. But there are other things they could do. The biggest target is probably converting taxes on carried interest for private equity managers from capital gains to ordinary income. But it only gets you so far. But here's the real point. It kind of doesn't matter what they do. If you say revenue neutral, there's no stimulative impact. If I'm going to cut taxes over here and raise them just as much over there so that the impact on the deficit is zero, where's the stimulus? Where's the stimulus if I'm raising them as much as I'm cutting them? Well, there isn't any stimulus. All you're doing, you're saying this guy gets a bigger piece of the pie and somebody else gets a smaller piece of the pie, but you're not making the pie bigger. And so that right there, that takes away the stimulus effect of the tax cuts. As far as spending is concerned, we've got $20 trillion in debt. The U.S. debt to GDP ratio is, as I mentioned, 104%. Do you think they're going to throw another $1 trillion on top of that? Take the debt to GDP ratio past 110%? I mean, we're going to look like Italy before long. And so I think what Trump's going to find is that he's going to have to prioritize. He's going to have to pick and choose. He'll get some things through Congress, and they'll be popular, and he'll at least have the appearance of keeping some of his campaign promises. But the actual numbers, the actual stimulative effect of what's going to happen will be far less than the stock market is anticipating. They're going to find out that, maybe you can have roads and bridges, and maybe you can have defense spending, but you can't have both. Maybe you can have tax cuts on the rich, but you're going to have to increase them over here. So the hard reality is such that you're not going to get anywhere near the fiscal stimulus from Trump that the stock market is expecting. And the whole inflation trade is not going to materialize. And, oh, by the way, over here at the Fed's already said we're going to lean in. I mean, go back to what I said at the beginning of the call. The Fed threatened to not engage in helicopter money because we don't have deflation. They're worried about inflation. So the rhetoric is that, happy days are here again. We're going to have the Trump reflation trade, buy stocks, sell gold, sell bonds, etc. But that's the rhetoric. That's the market thinking. But the reality may be quite the opposite. The reality may be you get far less fiscal stimulus than you expect. And furthermore, you get a far tighter monetary policy than you expect. Well, that's a combination for a recession. Far from going into a ninth year of an expansion. If you do that, and if the Fed's always behind the curve, so if the Fed's sitting there waiting for evidence to show up, by the time it shows up, and it could come as a very unpleasant surprise, when you look at, say, maybe first quarter GDP, which will come out at the end of April, or the March employment report, which will also come out at the beginning of April. And by the way, I do expect the Fed to raise interest rates in March, so we'll get that out there for the listeners. I've got a very high probability that the Fed will actually raise interest rates in March. But you take the March rate hike on top of the one we just had yesterday, on top of projected rate hikes, all of which is very, very much a tightening of monetary conditions. And then maybe by the end of February, the stock market gets a wake-up call. Oh, gee, we're not going to get the deficit spending that we were expecting, and the market's got to correct for that, and the stock market goes down, and that's the tightening of financial conditions. You might have extremely tight financial conditions by March or April, in which case everything's going to go in reverse. Stocks are going to go down. The Fed's going to have to go dovish. That's going to be bullish for gold. Bonds are going to go up again. Rates are going to come down. But not yet. I think it's very important, John, that we understand the timing and the sequence. I'm not saying go out and short stocks. That would be like standing in front of a train that's coming down the tracks at 100 miles an hour. That would be crazy to do today. So I would expect the Trump trade. So let's define the Trump trade. The Trump trade is, stocks up, interest rates up, bond prices down, gold down, stronger dollar. I would expect all those things to continue for a while, at least through the end of the year, maybe into early next year. But probably not later than the end of February, I would look for all of those things to go into reverse for the reasons I mentioned. I don't want to just make claims. I want to explain the analysis. But when the reality of higher interest rates, the reality of tighter monetary policy, think about what the strong dollar does. That's deflationary. If you have a stronger dollar, that means an American who wants to buy French wine or go on a Swiss vacation or even buy clothing from China and Costco, all those things cost less if your dollar's worth more. That's deflationary. So how does the Fed get to inflation with a strong dollar that's causing deflation? They can't, right? See, these are the conundrums. These are the paradoxes that we're confronting. But none of this stuff will be apparent today, except for our listeners. It will become apparent, I would expect, by kind of end of February, March, going into April, and then every one of these trades is going to go in reverse, and then that's when gold will go up, the dollar will go down, interest rates will start to come down. By the way, just to have a little pop quiz for the listeners, I don't know if they have a way of emailing in their answers, but does anybody know what interest rates were on the 10-year Treasury note yield to maturity at the end of 2013? The answer is 3%. They were over 3%. Today, they're, I think, about 2. I don't have a screen open right now. It's about 2.6%, maybe a little bit higher than that. My point is, interest rates were higher 3 years ago than they are today. If you went out and bought 10-year Treasury notes at the end of 2013, you got a nice 3% yield in the meantime, and you still have capital gains because rates are about 2.6%. They're lower than they were when you bought them. That means the price of the bond goes up. My point is, all you hear today is, the bond bubble has burst, interest rates are going up, bond prices are going down, blah, blah, blah. Sorry, their actually yields are lower than they were 3 years ago. So, and gold prices are higher. So, yeah, the short-term trends have been negative for bonds and gold. Rates higher, bond prices down, gold down, stock up. I get all that. It's not a lot of fun if you're sitting on gold, but I would suggest that people keep it in perspective. Understand that gold prices are up in the 21st century. They're up in the year. They're not up as much as they were, but they are up. They're up on over this time period. Certainly, bond prices are up in the last 3 years. So you got to put these things in perspective. And I don't think March or April is that far away. And I think by the time we get to the spring, we might see a complete reversal in all these trends. But for now, the trends are intact, and the Trump trade is alive and well.
Well, thanks, Jim. That's a very full answer, very, very rich in information. And Alex?
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.